Viewers at home, you are welcome to my presentation on branch account. Branch account. In this presentation, I will examine the meaning of branch account. Meaning of branch account. 2. Types of branch. Types of branch. Then methods. Methods of invoicing goods. Invoicing goods to the branch by the head office. Then accounting entries. Accounting entries to record each method. Finally, I will provide worked examples. If you are just coming across this channel for the first time, or if you have not subscribed in the past, please don't forget to click the red subscribe button and also turn on the notification bell icon so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you and God bless you. What do I mean by branch accounting? Branch accounting is a system of bookkeeping. System of bookkeeping in which separate accounts are kept. Accounts are kept for each branch of the of an organization. Branch accounting is a system of bookkeeping in which separate accounts are kept for each branch of an organization. I said branch accounting. I said it's a system of bookkeeping in which separate accounts are kept for each branch of an organization. When you say branch, just like if you have a tree, this is the body of the tree, which is also called the trunk. This is the trunk of the tree. Then you have different branch of the tree. So different branch. So meaning that branch on its own is part of a tree that grows out from the trunks. The part of the tree that grows out from the trunk is said to be the branch. Just like the part of a company or part of an organization that is located elsewhere is said to be the branch. If the head office is in Lagos, the branch may be in Akure. If the branch is located, the branch of that organization that is located elsewhere, separate from the head office, is said to be the branch. So what are the types of branch? Types of branch. For our purpose, I'm going to categorize branch into two. Number one, we have dependent branch. Dependent branch. As the name implies, depend. That is, they depend on the head office. The branch that does not have full control over their activities. Any branch that does not have full control of their activity is said to be the dependent branch. A dependent branch does not have control over their accounting records. The cost and profit of a dependent branch will be redirected to the head office. The cost and profit of a dependent branch will be redirected to the head office. That is, the dependent branch does not have full control over the accounting records. The accounts of a dependent branch will be maintained by the head office. Number 2 is independent branch. Independent branch. This one, the branch that does not depend on the head office. So that is, they have full control over their accounting records. They have full control over their activities. They can purchase inventory on their own. They can prepare their accounts on their own. Their profit will be kept within them. That is, their profit will not be redirected to the head office. That is independent branch. A branch that has full control over their accounting system is said to be an independent branch, while a dependent branch does not have full control over their accounting records. So what are the methods? Methods of invoicing goods. Methods of invoicing goods. Invoicing goods to the branch by the head office. By the head office. Number 1 method is the cost price method. The cost price method. Number 2 is the cost plus markup. Cost plus markup method. And number 3 is this invoice price. Invoice price or selling price method. These are the 3 methods of invoicing goods to the branch by the head office. Number 1 method is the cost price method, while number 2 is cost plus. You can call it cost plus method or cost plus markup method. You either call it cost plus method or cost plus markup method or cost plus a fees percentage method, while the 3rd method is the invoice price method or selling price method. I am starting with the cost price method. So what do we mean by the cost price method of invoicing goods to the branch by the head office? Under this method, the head office invoices the goods to the branch at the cost to the head office. The head office sent goods to the branch at the cost to the head office. That means if the item cost the head office $1,000, by the time the head office wants to send it to the branch, it is that cost price of $1,000 that it will be sent to the branch. In that case, it is the branch that will determine the amount of profit to make on the transactions. It is the branch that will determine the amount of profit to make on these transactions. This method is suitable for perishable items. Those items that can damage in a short time, like tomatoes. So, if the head office wants to send those goods to the branch, they will send it to the branch at the cost of the item to the head office. What are the accounts required under the cost price method? Accounts required. Number 1 account is branch inventory account or branch stock account. Number 2, we have goods sent to the branch account. Number 3, we have branch receivables account. Number 4, branch expenses account. Number 5, branch profit or loss account. Number 6, statement of financial position. Statement of financial position of the branch. So these are the accounts required, and then we can as well prepare the head office current account in the branch book. Let me add that. Head office current account in the branch book. Then finally, you can as well have branch cash book. These are the accounts you will need to maintain under the cost price method. I am starting with number 1, branch inventory account. The branch inventory account. Branch inventory account or branch stocks account. This account performs a dual function. It performs 2 functions. Number 1, the function of branch inventory, that is the function of branch stocks, and the function of branch trading accounts. These are the 2 functions performed by the branch inventory account. By branch inventory, that means this account shows the movement of branch inventory items. It shows the movement of inventory. The movement of inventory between the branch and the head office and the branch customers. I said the branch inventory account shows the movement of inventories or stocks between the branch head office and the branch customers. So, meaning that anything that affects inventories will be recorded in this account. An increase in inventory, item that increase, you are going to debit to this account. Debit increase in inventory. Any item that will lead to an increase in inventory, you debit it to this account. And credit item that will lead to a decrease in inventories. You debit to this account item that will lead to an increase in inventory, and you credit to the branch inventory account the item that will lead to a decrease. We are still going to a detailed accounting entries. The second portion is the functions of branch trading account. Remember, trading account, we use it to determine the gross profit. That means the gross profit or gross loss of the branch. Gross profit or gross loss of the branch will be determined from the branch inventory account. Remember, I told you that this account performs two separate functions. The number one function is functions of branch inventory, where I told you that the movement in inventory items will be recorded in this account. Number two function is the functions of branch trading account. That means it is from this account that we are going to determine our gross profit or gross loss of the branch. These are the two functions performed by the branch inventory account. What are those items that we need to be recorded in the branch inventory account? Items that will be recorded in the branch inventory account. Number one, we have the opening and closing balance of inventory, opening and closing inventory. Number two, goods sent to branch by head office. 3, goods returned by the branch to head office. 4, goods returned by the branch customers to the branch. Goods returned by the branch customers to the branch. Number 5, credit sales by the branch. Number 6, cash sales by the branch. Number 8, goods damage at the branch. 8, goods damage at the branch. Number 9, goods stolen at the branch. Number 10, cash stolen at the branch. All these items that affect the items of inventories will be recorded in the branch inventory account. Remember, I said earlier that items that will lead to an increase in inventory, I said it will be debited, while items that will lead to a decrease, I said that will be credited. So your opening balance, being an inventory account, remember inventory is an asset, therefore the opening balance will be brought down to the debit side of the branch inventory account. Now, where goods are sent to branch by head office, goods sent to branch by head office sends goods to branch. When branch receives it and puts it in their store, the inventory of the branch will increase. In that case, you are going to debit the branch inventory account with the goods sent to branch. Goods returned by branch to head office, where branch return part of the goods received from head office back to the head office. That means the inventory of the branch will reduce. So with the value of the goods returned by the branch to head office, you are going to credit the branch inventory account since the inventory will decrease. Remember, I told you items that will lead to reduction in inventory, I said that will be credited to the branch inventory account. Goods returned by the branch customers to the branch, where customers return part of the goods they have bought back to the customers. Upon the receipt of this item, when the branch receive them and include them in the store, that means the inventory of the branch will also increase. Remember, I told you item that leads to an increase in inventory, I said that will be debited to the branch inventory account. Then credit sales, where there are sales on credit, the inventory reduces. Therefore, this will be credited to the branch inventory account. Cash sales, where there are sales in cash, the inventory also reduces. In that case, the cash sales will be credited to the branch inventory account. Where there are damaged goods, where goods damage, the inventory reduces. That means this will be written off. In that case, you are going to credit the branch inventory account. Where there are goods stolen, the inventory will also reduce. So in that case, you credit the branch inventory account. Cash stolen will as well be credited to the branch inventory account. The number 2 account we will need to maintain under the cost price method is goods sent to branch account. Goods sent to branch by the head office. This account shows the movement of goods between the head office and the branch. It shows the movement of goods or inventory between the head office and the branch. Items that are usually recorded in goods sent to branch accounts include: number 1, goods sent to branch from head office. Head office. 2, we have goods returned by the branch to head office. 3, goods returned by the branch customers to the head office. These are the items that will be recorded in goods sent to branch account. Number 3 account that will be prepared is branch receivable account. Branch receivable account or branch debtors account. You either call it branch receivable account or you call it branch debtors account. This account records the transactions of the branch customers. Any transactions that occurred between the branch and their customers will be recorded in this account. I repeat, branch receivable account or branch debtors account records the transactions of the branch customers. So, items that will be recorded in this account include opening or closing. Let me say opening and closing receivable balance. That is opening and closing debtors balance. We have cash. We have credit sales. Then we have cash received from customers or cash received from debtors. We also have check received from customers or check received from debtors. We have bad debts written off. We have discount allowed. These are the items that will be recorded in the branch receivables or branch debtors account. Number 4, we have branch expenses, account. This account takes care of all the expenses of the branch. It records all the expenses of the branch. Expenses include salaries and wages, rent and rates, transport expenses, and so on. It records the expenses of the branch. Number 5, branch profit or loss account. This is the account where profits or losses of the branch will be ascertained. It is the account for ascertaining the net profits or the net loss of the branch. Then we have head office current account. Head office current account in the branch ledgers. Head office current account in the branch ledgers for recording the items between the head office and the branch. Then the statement of financial position. These are the accounts you will need to open in the branch books. Now, before we proceed, or before we take a work example, I therefore want to consider the accounting entries. Accounting entries in the branch ledgers or branch book. Everything will still be done in line with the principles of double entry. Remember the double entry principles to find that for every debit entry there must be a corresponding credit entry and vice versa. So it is in line with that principles that these ledgers will be opened. Remember, we debit the receiver, and credit the giver. Debit the receiver and credit the giver. Now, debit increase in assets, increase in expenses, increase in assets and increase in expenses. We debit them. We credit decrease in assets or decrease in expenses. And I want you to note that inventory and receivables, they are an asset. Inventory, that is your branch inventory account or branch stocks account. Branch stocks or branch inventory account. That is inventory or stocks are assets. Branch receivables account or branch debtors is also an asset. Receivables is an asset. Stocks or inventory is also an asset. That means any increase in assets, that is your branch inventory and branch expenses, anything that will lead to increase in them will be debited, while decrease to those items will be credited. Take note of that. Back to the double entry. I told you that the principles is the principles of double entry. For every debit entry, there must be a corresponding credit entry. Now, number one. Now, opening inventory. Opening inventory or opening stock. Opening stocks. The opening balance in inventory. Inventory being an asset must have a debit balance. So you are going to debit branch inventory account, or you debit branch stock account with the opening inventory or opening balance, opening stock. Then 2, opening receivables or opening balance of debtors. Opening receivable balance or opening debtors balance. You also debit branch receivables account or branch debtors account as balance brought down or balance brought forward. You can as well have this as balance brought down or balance brought forward. Number 2, goods sent to branch by the head office. Goods sent to the branch by the head office. These transactions will affect the branch inventory and the goods sent to branch. Remember the double entry principle. For every debit entry, there must be a corresponding credit entry. Goods sent to branch by the head office. Where head office sends goods to branch, the branch receives the goods and put it in their stocks. Therefore, the branch stocks will increase. That is, the branch inventory will increase with the amount of the goods received from the head office. Since the stocks increases, remember I said anything that will lead to an increase in stocks, I said that will be debited to the branch stock account. So in that case, you debit branch stocks or branch inventory account and credit goods sent to branch account. Now, number 4, goods have been sent to branch by the head office. Upon the receipt of the goods, the branch discovered that some of them are bad. What would they do? They will return them back to the head office. So we have goods returned to the head office. By the branch. Where branch return goods to head office, the goods is actually going out of the inventory of the branch. Therefore, the inventory of the branch will reduce with the amount returned. The inventory of the branch will reduce by the amount of goods returned by the branch. So I'll tell you that where inventory reduces, that you are going to credit the branch inventory account. Then this transaction will affect branch stocks or branch inventory account and goods sent to branch account. So since inventory will reduce, you are going to credit branch stocks or branch inventory. You now debit goods sent to branch account. Debit goods sent to branch account and credit branch inventory account. Remember, considering the cost price method. Number 5, cash sales by the branch. Branch have now sold some stocks, and when branch sells goods, they will receive cash. Therefore, this transaction will affect the cash book of the branch. It will affect the branch cash or bank account. Now, inventory reduces when goods are sold. Therefore, it will also affect the branch inventory or branch stocks account. I have told you that anything that will lead to the reduction in the branch inventory will be credited to the branch inventory or branch stocks account. So in this case, since cash is received, therefore we are going to debit branch cash book, branch cash or bank account or branch cash book, and credit branch inventory account. That is number 5. Number 6, credit sales by the branch. Branch sells some goods on credit, and when goods are sold on credit, this will affect the receivables, and the inventory of the branch will reduce. Receivable is an asset. Remember, I've told you anything that will lead to an increase in asset, I said it will be debited to the asset account. And remember, receivable is an asset, inventory of stocks is also an asset. Receivable and asset will increase. That means branch receivable will increase. So you debit the receivables account. Debit branch receivables account. Receivables account, because receivables increases and asset increase. You credit. It's also affecting inventory because inventory will go out. The branch inventory reduces. Inventory is also an asset. Since it reduces, I've told you that anything that will lead to reduction in an asset, I said it will be credited to the asset. Therefore, since inventory is reducing, you credit branch inventory account. That is number 6. Number 7 now. Number 7, some of the goods sold to the customers have not been returned by the customers to the branch. Goods returned by the branch customers to the branch. Where customers return goods to the branch, upon the receipt of the goods, the branch will include them in their stocks or inventory. That means the inventory, that is an asset, will increase. So in that case, you debit branch inventory account and credit. Remember, it was returned by the customers, which is their receivables. The amount owed by the customers will reduce whenever goods are returned by such customers to the branch. So the receivable and asset reduces. I'll tell you that anything that leads to a reduction in an asset, I said that will be credited to an asset account. So since receivable reduces, you credit branch receivables account. That is number 7. Number 8, goods returned. Goods returned by the branch customers. Branch customers to the head office. This time the branch is not returning it to the branch. I mean the customer is not returning the goods to the branch but to the head office. That means branch is not putting this one in their stocks, but it is the head office that received the goods directly from their customers, from the branch customers. In this case, the customer, which is the receivable, reduces. You credit the receivable, it's an asset, it reduces. You credit reduction in assets. So you are going to credit the receivables account, branch receivables account, then you debit goods sent to the branch account. Debit goods sent to branch account, then you credit branch receivables account. Number 9, bad debts. Bad debts written off. Bad debts affect the receivable. Receivable reduces, an asset reduces. So you credit the branch receivables account, then you debit bad debts account. Debit bad debts. Bad debts account, or bad debts and expenses, or you debit branch expenses account. You credit branch receivables account. Number 10, discount allowed by the branch to their customers. Discount allowed is also an expenses. And when the branch give discount to their customers, the amount the customer is owing will reduce. So remember, receivable is an asset. We are going to credit the branch receivables account. Now debit discount allowed. Debit discount allowed, or branch expenses, or debit branch expenses account, and credit branch receivables account. Number 11, the expenses of the branch. Expenses of the branch paid by the branch. Branch paid some expenses on their own. So that means cash goes out whenever the branch pays for such expenses. Cash is an asset. Cash reduces when they paid for an expenses. Since cash reduces, you are going to credit the cash book. Then you debit the branch expenses account. Debit branch expenses account. Debit branch expenses account, and credit branch cash or bank account. It is possible the head office might pay for some of the expenses of the branch. Expenses of the branch. Expenses of the branch paid by the head office. And where head office paid for the expenses of the branch, you are still going to debit branch expenses account. Then you credit head office current account. Debit branch expenses account and credit head office current account. Number 13, authorize allowance of selling price. under the cost price method, this should be ignored. It should be ignored. Number 14, cash stolen at the branch. In this case, where cash are stolen, you are going to write it off. So you debit profit or loss, branch profit or loss account, or you debit defalcation account and you credit branch stocks account. You credit branch stocks account or branch inventory account. Then we have goods stolen at the branch. Goods stolen at the branch. You can debit defalcation account, or you debit profit or loss. Debit branch profit or loss account, or you debit defalcation account and you credit branch inventory or branch stocks account. And where goods are damaged, goods damaged at the branch, you also write it off with the profit or loss. In that case, you debit branch profit or loss account and you credit branch inventory account with the amount of damaged items. Then finally we have the closing balances. Number 17. Closing balance. Closing balances in respect of number 1, inventory. In that case, credit branch inventory account as balance carried down. And closing receivable balance. Closing receivable balance, you credit branch receivables account as balance carried down. Closing cash balance. Closing cash balance. You are going to credit branch cash or bank account as balance carried down. Then the difference between the debit and credit side of the branch inventory account. So where the credit side of the branch inventory account exceed the debit side of the branch inventory account, you have the gross profit. That is excess of the credit side of the branch inventory account over its debit side. Represent gross profit. And where the debit side exceed the credit side, it could be a gross loss. So a gross profit will be close to the profit or loss. In that case, you debit branch inventory account with the gross profit debit branch inventory account, and you credit branch profit or loss account. You also need to close all the branch expenses to profit or loss. In that case, you credit your branch expenses, you debit profit or loss. The difference between the debit and credit side of the branch profit or loss represent the net profit. Where the credit side exceeds the debit side, you have the net profit. And where the debit side of the branch profit or loss exceeds its credit side, then you have the net loss. So that is the accounting entries. Now I want to take a work example. Example: ACCA Limited, with head office in Akure, operates a branch in Ibadan. The following balances were extracted from the records of Ibadan branch. Opening balances 1st of January 22x. Branch inventories at cost to head office 6,300 naira. Branch receivables 2,710. Branch bank 1,820. Closing balances 31st December 22x. We have branch inventories at cost to head office 4,800. Transactions at Ibadan branch during the year were goods transferred from head office to branch at cost to head office 12,900. Goods returned from branch to head office at cost to head office 240. Cash sales paid into bank 2,520. Credit sales 16,240. Goods returned to branch by credit customers at selling price 60 naira. Check received from credit customers 17,010 naira. Discount allowed to credit customers 150. Bad debts written off 30. Cash transferred from branch bank to head office bank account 17,390. Rent and rates 220. Wages 80. General expenses 70. Salaries of the branch staff paid by the head office 750. Required. Post the respective accounts. That is the question. Now let's have the solution. Solution. The first account is branch inventories account. Branch inventory account. We have the debit side and the credit side. The debit and the credit sides. Now back to the question. Opening balances at 1st of January 22x. Branch inventories 6,300. Remember, I've said that the opening balance in the branch inventory, since an inventory is announced, that it will be brought down to the debit side. So now let's have balance brought down, or balance brought forward 6,300. Then we also have branch receivables This is the opening balance in respect of the branch receivables. Now let's open the branch receivables account. Branch receivables account. It is also an asset account. An asset should have a debit balance. It should have a debit balance. The opening balance will as well be brought down. Balance brought down. Branch receivables, the opening balance is 2,710. 2,710. Then we also have the opening balance in branch bank account. Branch bank account. Opening balance. Branch bank account. Bank account is also an asset account. Remember, I told you that an asset should have a debit balance. So the opening balance will as well be brought down to the debit side. Balance brought down. Branch bank account 1,820. 1,820. Closing balance. This is the closing balance. Let me leave the opening, the closing balance first. Transactions at Ibadan branch during the year where the first item is goods transferred from head office to branch at cost to head office 12,900. This is goods transfer from head office to branch. That is goods sent to branch. Remember, I told you that goods sent to branch should where head office send goods to branch. Upon the receipts of the goods by the branch will include it in their inventory. Therefore, inventory asset account will increase. And I've told you that any item that will lead to an increase in assets should be debited. And while those items that will lead to a decrease in assets should be credited. So, since the inventory would increase, therefore you are going to debit branch inventory account and you credit goods sent to branch account. Now, in the branch inventory account, we have goods sent to branch, and that amounted to 12,900. 12,900. You therefore credit goods sent to branch account. Goods sent to branch account. We've debited the branch inventory account. So we credit goods sent to branch. We have branch inventory. Branch inventory account. The amount involved is 12,900. 12,900. So that is for that. The next item is goods returned from branch to head office. Where branch return goods to head office, the inventory of branch will reduce by the amount involved, which is 240. So, since the inventory will reduce, you credit branch inventory account and debit goods sent to branch account. So now, let's credit branch inventory. Inventory reduces, asset reduce. So we have goods sent to branch, and the amount involved is 240. So you credit branch inventory account, you debit goods sent to branch. This is goods sent to branch, branch inventory. This is goods sent to branch account, so we debit it, 240. So that is for that. Then the next item, we have cash sales paid into bank. Cash sales paid into bank. Where there are sales of an item of inventory, the inventory of the branch reduces. So we have cash sales. Since inventory reduces, you credit branch inventory accounts. Cash sales, the amount involved is 2,000 520. 2,520. You credit branch inventory account. Cash is received. Since cash is received, you debit branch bank account. So we have branch inventory was credited, so you debit branch bank account. Branch bank account with the amount credited to the branch inventory, which is 2,520. So it is the branch bank account that has been debited here, not branch inventory. It is the title of the account that has been debited. Now, the next account is credit sales of 16,240. Since there are sales on credit, the inventory of the branch, which is an asset account, the inventory account, that is asset account, will reduce. So since the value of the asset inventory have reduced, you are therefore going to credit the branch inventory account. And since these sales have not been paid for, the receivables asset will increase. Therefore, you debit the branch receivables account. So with debit branch receivables account, you credit branch inventory account. So now we have branch receivables. That is credit sales. Let me just put credit sales. The amount involved is 16,240. 16,240. You credit branch inventory account. You then debit the receivables account. So branch inventory. That is your credit sales. Credit sales of 16,240. 16,240. Then the next item is goods returned to branch. Goods returned to branch by credit customers at selling price, which is 60. Goods returned to branch, where goods are returned to customers, are returned to branch by the customers. The branch will receive the goods and include it in their inventory. Therefore, the inventory of the branch increase by 60. If inventory increase, you are going to debit the inventory asset account. While the receivables reduces, you credit the branch receivables account. That is goods returned, 60. Now, you debit branch inventory account. That is goods returned by customer. That is 60. You now credit receivables account. Goods returned by customer, 60. So that is for that. Then the next item is check received from credit customers, 17,010. The receivable reduces where the customer paid for what they were owing. Therefore, since receivable reduces, you credit the branch receivables account, then cash increases, you credit branch bank account. So the amount is 17,010. So branch receivable 17,010. Then you credit branch receivables account. We have branch bank, branch bank account, 17,010. Then the next item is discount allowed to credit customers. Now the discount is given to customers. Discount allowed is an expenses. Therefore, you are going to debit the discount allowed account. Then you credit the receivables account. Receivable is an asset. So we have the discount allowed. The amount involved is 150. You are going to debit the discount allowed account, that is the branch expenses account. The next item is the bad debts written off. Bad debts is also an expenses. You are going to debit the expenses because expenses increase. Then the receivables reduces. You credit the branch receivable and asset account. So we have bad debts written off, and the amount involved is 30. The next item is cash transferred from branch bank to head office bank account. There is an interswitch transfer from the branch bank account to head office. That means the money in the branch bank account will reduce. Remember, branch bank account is an asset. You credit the branch bank account and you debit the head office current account with the 17,390. Credit bank account, so head office current account. The amount involved is 17,390. 17,390. You credit the bank, branch bank, then you now debit head office current account. Head office current account in the branch ledger. So we now have the amount is 17,390. 17,390. So branch bank account. The next item is rent and rates. Rent and rates is an expenses of the branch paid by the branch. Therefore, you debit branch expenses account and you credit branch bank account. So rent and rates, the amount involved is 220. So credited to the branch bank account. That means the branch expenses account must have been debited with the same amount. Then wages. Wages is also an expenses which will be debited to the branch expenses account, that is wages account. You credit the branch bank account. So we have the wages and the amount involved is 80. So the debit entry will be in the wages account, which is the branch expenses account. The next item is general expenses. General expenses. So you are going to debit the branch expenses account, then you credit the branch bank. General expenses. So because the money is paid through the bank, the amount involved is 70. Finally, you have the salaries of the branch staff paid by the head office. This is an expenses of the branch which was paid by the head office. In that case, you are going to debit the branch expenses account, then you credit the head office current account. So salaries and wages of the branch staff, the amount involved is 750. Remember, this is an expenses of the branch which was paid by the head office. So that is the last item there. Now, finally we close the account. You have the closing balances. Closing balances as at 31st December 22X. You have branch inventories at cost 480. That is the closing balance. Remember, I told you that the closing balance in the branch inventory account will be credited to the branch inventory account as balance carried down, and the amount involved is 4,800. Now, you now total it. You total it. Now, let's sum up the credit side. We have 240 plus 2,520. No, this is branch inventories account. 240 plus 2,520 plus 16,240 plus 4,800. Then the credit side is total 23,800. 23,800. Now, What is the total of the debit side? 6,300 plus 12,900 plus 60. The debit side is total 19,260. That means the credit side exceeds the debit side. You know the credit side is 23,800. When you now subtract the sum of the debit side from that, from the total, there is a difference of 4,540. That difference represents the gross profit. Gross profit carried down. So the closing balance of 4,800 will be brought down here. We have it as balance brought down. The closing balance for this period will be the opening balance of the next period. Now, that is branch inventories account. The gross profit here will be close to the branch profit or loss. Branch profit or loss account. We have the gross profit. Gross profit brought down 4,540. Now, let's close the receivable account. The total, the debit side is totaled 2,710 plus 16,240. Then we have 18,950. 18,950. Now the credit side, we have 60 plus 17,010 plus 150 plus 30. The credit side is total 17,250. By the time you subtract it from the total of the debit side, then you have the difference of 1,700. That will be the closing balance. 1,700. 18,950 is the total. So the closing balance will now be the opening balance for the next period. Balance brought down 1,700. That is branch receivables account. When goods sent to branch account, the balance there will be close to head office trading account. Trading account. That is in the head office. They have head office trading account. The credit side is 12,900 and the debit side is 240. Then we have the difference of 12,660. 12,660. So total is 12,900. That is head office trading account. Now, branch bank account. Branch bank account. The debit side 1,820 plus 2,520 plus 17,010. The debit side is total 21,350. 21,350. Now, let's sum up the credit side. We have 17,390 plus 220 plus 80 plus 70. The credit side is total 17,760. By the time you subtract it from the total of the debit side, 21,350, then you have the difference of 3,590. 3,590. That is the closing balance. So total is 21,350. That closing balance will be the opening balance for the next period. Balance brought down 3,590. Now, head office current account, we may leave that unclosed since there could be other items that will be entered by the head office. Now, the branch profit or loss account. Now let's record the expenses there. We have the first item head office current account, that is one-time expenses. Rent and rates 220. Rent and rates 220. Then we have wages of 80. Wages 80. Then we also have general expenses of 70. General expenses 70. Then we also have salaries and wages of 750. Salaries and wages of 750. Then in our receivables account, you have discount allowed of 150. Discount allowed 150. Then we also have bad debts written off of 30. Bad debts written off. Bad debts written off, and that amounted to 30 naira. Now let's sum up all the expenses. The debit side 220 plus 80 plus 70 plus 750 plus 150 plus 30. The debit side is totaled 1,300 and the credit side is totaled 4,540. By the time you subtract the total of our debit side from the total of the credit side, you have the net profit. Net profit. Net profit of 3,240. So total is 4,540. So that is the end of the solution to that work example. This is the part 1. In part 2, I will examine the cost plus method. Cost plus markup method. Please don't forget to like, share and subscribe. Thanks for watching ACCA.